Passive Pockets is presented by Equity Trust. Welcome to Passive Pockets, the passive real estate investing show brought to you by Equity Trust. I'm Jim Pfeifer here with Paul Shannon and our new co-host of the show, friend of the podcast, Chris Lopez. Welcome, Chris. We are happy to have you.
I'm excited to be here, Jim and Paul. Thanks, guys.
And to get Chris properly initiated, we are also launching a brand new recurring format, our PassivePockets Pulse Check. Every month, starting today, the three of us will break down what's been happening in the world of passive investing, from the latest trends and market movers to the returns and adjustments we've seen in our own portfolios, plus what we expect for the month ahead. Today, we are going to talk about our individual investment theses, deals we've invested in, both good and bad, and where we expect things to go moving forward.
Yeah, and it's a great way not to just talk theory, but to share exactly what we're doing as investors, the good, the bad, the ugly, and the lessons we've learned and how we're moving forward. Plus, we're going to share some behind-the-scenes updates as to what Passive Pockets as a community is focused on and building, and also sharing real performance numbers and talk about what's on our radar for the coming months and the coming years.
Yeah, think of it as a combination of market insights, portfolio transparency, and community highlights, all in one episode, really.
All right, let's get into it.
And I want to start off with talking about what Passive Pockets is up to. Now, this is kind of like a behind-the-scenes look. And the reason I want to have Jim and Paul chime in on here is because what makes Passive Pockets so powerful and so unique is the community. And it's really understanding how the community can help, you, the investor, go out there and find better deals and also feel confident about the deals. Because we consistently hear from surveys and talking to members out there is that they want more due diligence techniques and also how do you develop more trust with the sponsors. So Jim, I know the community is your baby here. I think it's a good starting point to talk about how community resources and community due diligence is very important and also very powerful for Passive Pockets.
Yeah, I mean, it's the reason we started the community, because there's two crucial factors in this evaluation, and one is the sponsor, and that's what we've always said is the most important. Make sure that you know, like, and trust the sponsor and get referrals and all that to the sponsor. And then there's the deal. So once you join the community, how do you go about getting help in those areas? And that's something I think we want to talk about a little bit, because it's one thing to say, go on the forum and say, hey, has anybody ever heard of ABC sponsor? Right? Then you can get some feedback. But it's different if you just go on the forum and you post, hey, I'm looking at this deal from ABC sponsor, and you post a video and the PDF and you say, what do you guys think? You're not going to get a response to that. And we can talk about why, but for me, it takes a lot of time. And I know, Paul, we do those deal reviews. Chris, you do as well. And they take a lot of time to do. So we aren't able to jump in and give you our 3-hour tour of each deal, right? You have to do the work first and then ask for people's opinions.
Yeah, I would agree. I think it makes sense why we're seeing the data show that investors want more due diligence exposure, how to do due diligence, and want to trust sponsors more. Those are the most critical factors when investing. Not jumping into a deal that looks shiny with great metrics that are, on a pro forma, but actually understanding who can execute this, who's actually giving us realistic assumptions based on their past experiences and who has the team to get it done. But then there's all the combing through the weeds. You can go on to the SEC's website and look at their blacklists. There's multiple sites that you can look for that maybe sponsors have been flagged before. And that's obviously a red flag not to invest. But I think it just comes down to reps and community. Going back to what you said, Jim, I think it's connecting with other investors who have the experience of maybe investing with that sponsor and can give you their take on it and share what, kind of their track record has been with investing with that sponsor. And then it's just getting the reps. And that's what the deal review is all about, is kind of teaching people how to fish versus feeding them the fish and giving them the opportunity to see how we look at deals, analyze PPMs, subscription agreements / operating agreements, and analyze the metrics in the deal in the market to make more educated decisions around investments. And at the end of the day, investment decisions are personal. We cannot tell you what your risk tolerance is or what part of your portfolio you're trying to fill. All we can do is kind of highlight what we see in the deal and why we might like to invest in it for our specific personal situations.
Yeah, and one thing I'd like to add, when Paul said teach you to fish rather than give you the fish, I think the deal reviews are a great example of that. And at the same time, if you have a deal and you want to post it to the forum and ask people's opinions, it's your responsibility to do all of your work ahead of time, analyze the deal, give your thoughts, say, here's the questions I was thinking about asking the operator, and put everything you have into it and give it in a package where then people that want to help you and learn with you or from you or teach you can look at all the stuff you've already done and say, hey, here's something you missed. Hey, think about this, rather than just posting it and expecting everybody else to do the work for you. PassivePockets is designed to teach you how to fish, not to be throwing fish out to people.
Yeah, I totally agree. And one thing I'll add on there, when people like ask us, ask other community members out there, like there's a big difference of like, oh, I'm looking at a deal versus, oh, I'm considering investing $100,000 into it, right? When it's personal capital invested, you care a lot more when it's your money versus, hey, I'm not looking in there. So understand, when it comes down to your money, no one's going to care more about it than you. But I think this is where, again, to reiterate the point, lean on the community. Go on there and ask the community. But go on there, with your work done, and also go on there and help the community. Because I learned a lot from reading those forum threads. Jim, Paul, and I, we've done like a lot of prep work, for deal reviews. Like we have some lively debates. Well, Paul will have a perspective on there that I've never thought of when it comes to underwriting, right? I'm like, holy smokes, I need to add that to my checklist here because never thought of it. I'm going to incorporate on there. And so I'm always learning from other people as well. And
I think engaging in the forum, right? It's a give and receive kind of thing. So if you are posting a deal on the forum, then you owe the rest of the community to do your own due diligence first and put yourself out there and say, here's what I'm thinking. And then it's a lot easier for other people. And now it's your turn, right, community? Someone put something out there. Now you need to take 5 or 10 minutes, review what they put in there, and give your opinion on it. In the forum, we need people to react and kind of do their due diligence first. And I think the same goes for when you're posting, hey, has anybody heard of ABC Sponsor? I think it's on you to say, here's how I heard of them. Here's why I'm thinking about them, not just to list 10 sponsors and say, hey, what do people think? Put some thought into it. And the more thought you put into your interactions in the forum, in the community, the more thought you will get back. So don't be surprised if you just say, has anyone invested with ABC Sponsor, and you get crickets? It's because you're not putting context behind that, I think.
And another thing, this is kind of some behind the scenes. So PassivePockets is doing a kind of a next round of actually doing some user interviews on, hey, how can we do a better website layout, a better tech layout as well, right? Because the less friction we have in navigating the spots we want, or, hey, some of these forums, there's no activity over there. We need to collapse these over here. So we are starting to go out there and actually do user interviews to improve the tech space. So if you are interviewed, please give us feedback. If you're interested, let us know as well. And also, we're always looking for new ideas on what type of content, what type of, group due diligence or content due diligence can we do to go out there to give people more insights into either specific sponsors, in the deal marketplace or just in general as well. And of course, a big thing we always focus on is education. And Paul, I know you've got a really cool national multifamily summit that you're putting together, and it's coming up really soon here. What's the high level of that?
Yeah, I'm really excited about this one, Chris. Thanks for giving me a chance to plug this event. It's a National Multifamily Summit. It's a panel. I'll be moderating with 3 panelists. We've got Jay Parsons, Greg Willett, and Eric Sussman, who are all veterans in the business. They're economists by trade, and they have very detailed knowledge of specific markets, what's happening in the housing markets, what's driving policy decisions, what's happening at a very micro level. So I think the theme of it is just going to be a healthy debate around where we're headed with multifamily specifically. What are the trends that are shaping the decisions behind acquisitions today? Where's capital flowing? And how can passive investors be better prepared to invest in deals as we move into the latter half of 25 and into 26? These guys are top-notch guys. I anticipate a great showing. We've already got 600 people registered the last time I checked a few days ago. So it's going to be well attended. And I think there'll be a lot of actionable insights coming out of this one.
That's fantastic, Paul. And just for everybody listening, if you like that kind of stuff, we also have our, we announcing formally right here, right now, PassivePockets Summit, the second PassivePockets Summit. And we're changing locations. We're going to do it in Denver. So we can be right next to, we can all go to Chris's house afterwards. It's May 1st to May 2nd next year, 2026.
So, great events on there. Again, plug in the community, be active, and also let us and also, the PassivePockets, team listen how we can improve upon it, because that's how we all get better together and do more deals together. So, something I want to focus on this monthly show we're doing here is just having a lot more us discussing deals, us debating, what type of deals we're doing. And before we get into some of the recent deals we've all invested in, I wanted to have you guys from a high level kind of talk about your investing thesis. Because something that I have noticed from a lot of investors, both real estate investors, and especially like passive investors, people invest a lot of deals, but I feel like a lot of times it's not been like intentional with like, oh, here is where this goes in the macro trends or the cycle we're in, or really understanding someone's risk tolerance. And so I think it's very good for us kind of talk about our personal investing theses and also encourage other people to go out there and have it themselves. And this tracks back to, I like to kind of challenge people. I think it's part of our role here is to challenge people in a friendly way. People write out their workout plan, they're out their meal plan, and then they're talking about moving millions of dollars. I'm like, oh, what's your written plan for your investing goal? Well, I don't have one. Oh, so you have your written plan for what you're eating this week, but you're going to invest 40% of your net worth next 2 years and you don't have like a structured way of written down. And, I'm a financial planner by college degree. And to me, that just is like insanity. So I want to spend a few minutes to talk about the investing thesis. Jim, I'm going to start with you again. I mean, from a high level, kind of like what is your investing thesis in the macro for Jim?
Yeah, I think it's a challenge, right? I think it's one of the hardest things to do. I agree with you. It's insane that people don't write it down. And at the same time, sometimes I don't write it down. So what I try to do at the beginning of the year is I look at how much capital I have available, how much I think might come available. And I kind of try to decide how many deals am I going to get into this year and what asset classes am I going to try to get into. The problem is I don't have any choice when one of my passive deals goes full cycle. So I get happy surprises all the time where, a deal went full cycle. Here's 60 grand in my account. Okay, well, if I had decided I was going to invest in 3 multifamily deals this year and I get that 60 grand and there aren't any multifamily deals available from the sponsors that I want to invest in, then what do, right? I have capital to allocate, so I have to pivot to something else. So I try to just on a one-pager put how much, how many, what asset classes, and maybe my top operators, just to guide me. And the only thing I know about that document is there is no chance that it's going to come to pass. It's going to be something different. But it gives me just kind of an idea of what I'm pushing for, right? And the challenge with passive investing is you don't know when your money's coming in and you don't know when the deals are going to be there to invest in. So you really have to be flexible and be able to pivot. And so that's why I kind of do it just a broad, general, one piece of paper thing.
What about you, Paul?
I like the approach, Jim, and I agree it is difficult sometimes because these are higher minimum investments. You don't know when you're going to be liquid. Timing, is always an issue, and things change in the marketplace. Deals are available sporadically, so that is certainly a challenge. But I think, before talking about a thesis, what is actually a thesis? It's really just a well-reasoned rationale for a specific investment decision, right? And I think if you can articulate what your investment thesis is, you're already 90% or ahead of 90% of the pack, right? You can't just take blurbs from what other people say and say, oh, I'm going to latch on to that. That sounds good. That's chasing the shiny object, so to speak. So you really need to be able to identify what your risk tolerance is and then come up with a plan. For me, it's sort of a barbell approach, and I'm talking about holistically as a portfolio. I take some higher risk positions that, maybe could be, crushed, but also have the opportunity to really go up in value. And then I focus on lower risk assets that are steady, pay cash flow, have a really good protection to the downside. So I'm focused more on that latter part of my portfolio right now. There's multiple theses behind different asset classes, but I'm, a multifamily guy at heart. And I think my thesis right now is driven by uncertainty. I think there's still economic uncertainty. Maybe there's starting to be a clear path to where we're sort of headed, but there's also policy uncertainty around tariffs and what we're doing with immigration and how, the global economy and, wars and everything look. So right now, I think that is a sentiment shared by a lot of investors, and it's really stalling transaction volume. There's not a lot of trades happening on the market right now. And that's actually okay for pricing. Pricing is holding. We're down about 18% in commercial real estate overall from the peak. I think over the last year, property values on average have gone up about 3%. So we're trending in the right direction, but sellers are not really motivated to sell and buyers are still uncertain and they want their price. While there's sparse transaction volume happening, if you can find either one, distressed sellers, or where I'm going here with the thesis is find assets that are newer, that don't have exposure to tariff risk, where you have like a heavy CapEx plan, where you've got day one cash flow, where you can acquire a property that's leased up or almost leased up and get day one cash flow, but the opportunity to grow that cash flow stream over time. And you're buying with positive leverage too, that's with fixed rate debt. With that type of scenario, we've got a little bit of supply glut right now in multifamily. If we can work through that, there's really nothing coming out of the ground over the course of the next couple of years. Supply is falling off a cliff as builders have found it more difficult to build, and build in a profit when they do these developments. So I think if you can acquire existing assets that are well maintained because they're new, that are pretty much leased up in markets that have a lot of demand with supply falling off, you've got cash flow, you've got positive leverage, those assets are going to perform in an all-weather environment. If we get an interest rate drop because we get a new Fed that comes in and starts lowering rates next year, asset prices are going to probably go up, right? But if we get that black swan event or we get some sort of an issue with tariffs or a war or whatever else, you've got fixed rate debt and cash flow already in place, so you can weather a storm. So that's my thesis.
I like both what you guys are saying, and I agree with a lot of what you're saying, Paul. And I've actually been updating my thesis right now. And a big part is I've been doing a lot of real estate deals last couple of years, and I kind of neglected my stock portfolio. I've been like a 90% type S&P 500 investor, kind of the Warren Buffett philosophy. And I was going to need to come back and kind of revisit my stock portfolio. Plus with, AI and crypto, I'm like, I just see the S&P 500 maybe not being 9% anymore. I just updated my thesis with this is don't bet against America. Because obviously I was looking at a lot of international stocks out there as a lot of people are doing. And also, politically, always half the country is very unhappy with who sits in power, vice versa. And regardless of what's going on in the world and who sits in office, my number one thesis is don't bet against America. While we have our problems here, I still have yet to see a better country out there from a high level. And so that was my number one thing is I am all America with my stocks, my investments, all that, other than whatever indirect exposure I have through some, S&P 500 companies. My second one is lots of diversification. I'm a big fan of lots of investments with lots of small checks. I have a lot of $25,000, $50,000 type investments.
And your accountant loves that with the K1s, right?
Well, yeah, but here's the thing. People are oh, how do you does that become a pain in the butt to manage? I'm well, kind of, but also I don't sweat that I have a huge chunk of my net worth into one sponsor, one deal. And now that one deal is sweating right now. So I would rather deal with the K1 headache and reading, 30 quarterly reports than, oh my gosh, if the deal goes sideways, my gains are wiped out for a year. The other big strategic thing I did is I now have, in my mind on my thesis, I have two syndication ladders. I have an equity syndication ladder and I have a debt syndication ladder. And the reason I started breaking things down, I always had it in the same one where, always dollar cost average the market. You said it earlier, Jim, you have no control when these equity deals usually, go full cycle. Expect, hey, this is a 5-year business plan. We know a lot of those multifamily business plans are 7 or 8 years now. The nice thing, so I separate those and I still do 2 or 3, 4 deals a year in there, but I also do 1 or 2 debt deals a year. Again, for diversification. And then I invest in more aggressive debt deals as well. I'll have a 1 or 2 lockup period. Well, hey, after I'm past that lockup period, I've got some liquidity on there. Unless it's a black swan event, I've yet to have a lender or a debt fund say, hey, we can't get your money back to you. It usually takes a month or a few months to kind of go through your redemption process. But I now have 2 syndication ladders that I focus on. And the last thing I'll add on there from a high level, and this goes back to some of the trends Paul was talking about with buying newer assets. I've invested in more development deals. I'm focusing on more Class A type properties. And I've done a lot of like most people, a lot of Class C, Class B multifamily value add over the years. And those they're challenging. And with where, prices are and expenses are, those deals just hard to get. So I'm a lot more focused on Class A, and I'm doing a lot more build to rent type investments. So, those are the horizontal multifamily with, 100, 200, 300 single family homes or whatever it is, because we have a 4 million, 5 million, 6 million housing shortage here in America. A lot of people can't afford a home or don't want to buy a home, but they're tired of having neighbors next to them, above them, below them, tired of elevators, tired of not having a yard. So I'm very big on the BTR space right now. And just development in general, as Paul said, hey, supply glut, that thing's burning off, into next year, and then it's a cliff. Hey, if you're delivering into a low supply environment, and we know we're at a macro housing shortage, to me, that feels very good about delivering a good product into a short supply market cycle.
This is why it's so valuable to be in a community, right? I just learned things from both Paul and Lopez, and I talk to these guys all the time. And, I've been trying to get people to talk about the Lopez ladder, right? Which is one of my theses. I think you guys said theses, and I'm thinking it's thesi, but when you have multiple theses. Anyway, the Lopez ladder for me was development, right? I never wanted to get into development because I'm cash flow. And Chris is like, well, if you invest in one development deal every year, then 3, 4, 5 years down the road, you're going to have one coming up every year. And that is essentially cash flow. So this year, we'll talk about it in a minute, but I did start my Lopez ladder. But now, Chris, you come in and you have 2 more ladders, right? So now there's too many ladders to have a tricky name like Lopez ladder. But I love the idea of the debt ladder, right? Because I keep thinking I want to get into more debt deals because it is cash flow pretty immediately. And, debt has been really good lately. You're on the better side of the capital stack. The problem is you might have to wait a year, 2 years, or 3 years for that liquidity. I don't know why I never thought of this. This is why I'm friends with Chris, right? Now you can do some year 1, year 2, year 3, and then your liquidity is always coming up. You don't have to get out of those deals. But the key thing is you have diversification. So if for some reason somebody can't give you liquidity, well, I've been doing we'll call it the liquidity ladder maybe. I don't know. I've been doing this ladder for so long.
Oh, that's a good one.
Thank you. I have 2 other deals that I can get liquid in. So I just think this is a great idea. And that's why these conversations like these are just great. I'm going to be so full of ladders that I won't know what to do.
And so full of K1s. Have you guys filed your taxes for 2024 yet? Just a poll real quickly. I have not.
No, it's not due till September or October, actually. So yeah, I'll get it done in October, Paul. It's only August.
It's the nature of the beast, right?
I still have a few K1s out there.
I just made a note this weekend. I was like, I got to start getting the tax prep ready to go for there. This is, I think, a good challenge for listeners out there is, update your investing thesis, your investing plan, we're going to call it, and write it down. There's a big difference in verbally saying it. Much easier, but if you have to write it down, it's much harder to communicate that way. So I'm a big believer in write it down if it's important. Losing weight, health, goals, investing, and then share it. I'm in the process of updating mine. I'm going to publish mine here on the forum here in a couple weeks if it's ready to go. So I'm going to share mine. Love to read others. Jim, Paul, love to see what you guys have as well. But that's kind of like my challenge to the community out there. And I guarantee, this is the one thing I'll guarantee out there, if you write down your investing plan, you will have better results. Just like if you write down your weight loss plan, you will have better results.
Yep. Even if you don't achieve what you have on that piece of paper or on that computer screen, you will still have better results because you will have intention to go towards a goal. And I hate making goals. I hate all that stuff, but I always try to write the one pager at the beginning of the year. Here's what my investing stuff's going to be this year. And it does help.
You're less likely to chase the shiny object too. You stay disciplined because you know what your parameters are. You created them already. And if you do start to deviate from that, you think about, well, maybe that wasn't the right thesis for me or the right risk tolerance type deal for me because I'm uncomfortable with this, that, or the other thing. And you refine it as you go.
Yeah. Before I go out there and sign docs and send off a wire, I kind of run through my thesis again. All right, let me just get out of shiny object syndrome. Because I'm like, that is like the greatest thing since sliced bread. All right, let's sleep on for a night and kind of compare what my rational thoughts are. So let's move on to the next topic here and actually talk about some recent deals we've invested in. Because like I said, I want to set up with the thesis conversation out there so people have clarity. And then when you invest in deals, it matches what your thesis and your risk tolerance is. Paul, since you've been going second, man, I'll start with you. What are some recent deals you invested in the last few months or this year?
Well, I actually was able to open a solo 401k this year for the first time. So I had some liquidity when I rolled over an old IRA. I liquidated the stock positions that were in it, and I had some capital to invest in passive deals, which was pretty exciting. So I tried to not get too excited and invest in the first things I saw and waited it out. But with the uncertainty in the market, I'm attracted to debt deals as well. So I invested in one of my own deals through InvestWise Collective, through Spectra Velocity Fund, one of our partners. It's been doing really well. We've had that position for a couple of years, so I just added capital to it. I invested in a single asset home renovation project, debt, first position in the capital stack with a known sponsor, Mag Capital Partners. They're known for industrial sale leaseback deals, but they do dabble in other endeavors. And this particular deal was a second position note. And I've done one of those with them before and had good success and was just looking for kind of a short-term year to two position. And I think the business plan is really sound. And they have a renovation plan for a really nice mansion that was built in the early 1900s, Aspen, Colorado, which is sometimes noted as the most luxurious real estate market in the country. So I think that's just really interesting to be involved in, and will pay, consistent cash flow. And
you get to use it for skiing, of course, right?
I hope so. Yeah, I certainly mentioned that to the group and saying, hey, if you guys have any personal use potential out of this for your investors, I might be somebody you might want to call, because I'll get out there in a heartbeat for that. The one equity deal I've done as of late is actually a development deal with AAA self-storage, which self-storage is not an asset class where I've heavily invested. I've never done a development deal with a self-storage operator before. This is a fund, so they're going to have multiple assets in it. They have not called capital yet. I've just signed the docs, and it looks like they're going to reach their minimum threshold to call capital around September or October. So I'll be getting involved there. I was just really impressed with that group. I will say, as a disclaimer, this is personal portfolio stuff. We're not making recommendations here as to, who should invest in what, but I just really liked the group, Paul Bennett, and have a lot of trust in what they're able to do, their track record, their core competencies and unfair advantages that they have in the markets that they participate. So it was just a piece of passive investing, that part of the passive investing world that I didn't have exposure to, and thought, hey, why not? I mean, this is as good of a sponsor as I think I'll find for this type of investment. And I could be totally wrong, but I think I have faith in their team, and I think that'll do pretty well. So I'm excited about that one.
What about you, Jim?
I've got a couple. I started my original Lopez ladder, as I mentioned, with the development deal, and I went in the new deal from Bar Down and Jay Scott, who I hadn't invested with before, and just really liked the deal. And I think if you guys don't follow Jay Scott for his economic updates and all his knowledge, then you're missing out. But I really like that deal, so I put some money down on that one. And then another operator that I like is Paul Shannon's InvestWise Collective, and they had a A-class multifamily deal in the Louisville area, which was actually in Indiana, I think. Anyway, I put some money into that one, and so those are the two I've done recently. And then I'm on the hunt for something. They always say you don't want the tax tail to wag the dog, or whatever that phrase is. But we did sell an investment property, one of our last investment properties this year, and now that we get the bonus depreciation is back, I'd like to offset some of those gains. So I am looking for probably a multifamily value add property coming this fall, so I can maybe offset some of that tax hit.
So Jim, I got to update my investing thesis here. What's my royalty off the Lopez ladder from your investments here? At least 10%, right?
10% of a beer the next time I see you.
Okay. Well, we'll edit that out, and we'll make sure that's a verbal contract. So I have done a lot of deals last 12 months, but the last few ones I've done is a build-to-rent community, actually in Dayton, MSA in Ohio. It's like 200 single-family home type BTR. Invested in a Colorado multifamily development fund. Just really like the location, like an amazing neighborhood in like Denver, and then also just a couple projects down Colorado Springs. And I live in Denver, so I know the sponsor very well, and I know the locations extremely well, where it's like, hey, location. Hey, these are pretty good. And hey, they're going to be delivering in 2 years when all of our supplies burned off. Did some more debt deals. And then finally been waiting for this, invested in my first truly distressed multifamily deal. I've been waiting for a couple years. I'm like, hey, when are the banks going to force some of these deals in the market? Got to invest in one in Omaha through a friend of mine. And so it was and I'm starting to see more like banks actually force properties on the market now. The extend and pretend, I think, is starting to burn up. Nothing major, but it's actually nice to see, all right, we're actually seeing some distress on here, buying it for like a super low basis, 50% what it was selling for a couple of years ago. Hey, that is a no-brainer in my book.
Love that you're starting to see some of that. It's got to happen to clear the deck, essentially. I saw one recently that I was very interested in, but I'm not as familiar with the sponsor, and I don't know them well, so I'm going to sit this one out. But I'm watching, and they're actually acquiring it for less than loan balance. So that kind of stuff is starting to happen out there, which is interesting.
Yeah, a lot of the commercial brokers, like I say, here in Colorado, every multifamily broker I've talked to this year in Colorado said, yep, we're actually finally starting to talk to banks that are bringing properties to market where it's been crickets the last couple of years. I'm assuming that's probably across other markets as well. As we all know, the survive till 25, that mantra does not work anymore. So we're starting to see some blood in the water. All right, so we got a few minutes left on here, but a question we always get asked is, hey, where's a good place to go out there and find deals? Of course your network is, but also go out there and make sure you check out the PassivePockets deal directory and marketplace. There's always a handful of deals in there. We do the LP deal reviews on them, and that is, in my opinion, a great source to go out there and just get more deal flow across your board, and then also be able to plug into the community group diligence to help kind of gut check if it's a deal that's a right fit for your portfolio. Make sure you plug into the PassivePockets deal directory there. And last few minutes here, we're going to talk about some bad news and some good news. We'll start the bad news first. Jim, what's some bad news in your portfolio?
Why does everybody always come to me with the bad news? But I got it.
Well, you do like talking about it.
I do, and I have the deals to prove it. So there's a few deals, and I'm just going to go briefly, and I won't say names, but most of us know who they are. There's a multifamily, well, I guess more than multifamily operator in Texas who's having some problems now with his multifamily deals, and the challenge there is there's two GPs on the deal, and now they're fighting for control of the assets, and they're accusing each other of different things, and I believe one of them, but it's really hard to know for sure. And the thing about it, I'm in one asset now that they're trying to sell, and I'm not sure who controls the asset. They think they can sell it and get like a 1.5 equity multiple. So it's going to be a pretty good result for deals that, he's had a lot of capital calls and a lot of deals have just, gone to foreclosure. So this would be a good result just to get my capital back, but to also get 50% more. That'd be great. But I don't know how it's going to happen because the GPs are fighting for control and they're trying to disassociate the other. And so it's just a complete mess. So that's one. Another one, San Antonio operator. And again, I'm speculating here. I guess you're going to ask me what the learnings were. So let me just explain the case. This one, I don't know what happened, but apparently commingling of funds happened. And then the FBI got interested, and now the assets are being monitored or sold or taken over by the FBI. So again, this is another asset that they could sell right now. The asset's performing great. There's been no problems. They paid distributions all the way through. And now, because of some problems with other deals and maybe commingling of funds, this asset, which we could get an pretty easy 2x, I don't even know if we're going to get capital back, or maybe we do get our 2x. So I don't know. And then the last one that we haven't talked about much, but we probably need a full episode on, are the ATMs, right? That was a Ponzi, 3 layers deep. And there's no resolution yet, so we can't talk to the principals. We know the principals, and when it gets out of the court and is resolved, we can talk more about it. But those are 3 deals that just have struggled, and happy to talk about, maybe some red flags, what we missed, and learnings for next time.
You got any deals that are struggling, Paul?
Well, I'm in both that San Antonio operators deal that Jim mentioned, as well as that ATM fund also. And,
see, it's not just me. Even smart guys get in these deals.
Yeah, and there's guys that are a lot smarter than me that are involved, in particular with the ATM deal. And it's interesting because you do your due diligence, you rely on other people's opinions somewhat, but I'm someone that gets into the weeds. I read the documents. I try to do background checks on sponsors. But at the end of the day, this is one of the biggest risks in the space, is just this bad actor, right? That you never see coming. You try to give your best assessment of a person's values and what their mantra is and how they're going to act, and are they going to be a fiduciary of my capital? But when stuff hits the fan, so to speak, what is their personality going to be like at that point? When the struggle comes, are they going to be putting you first, or are they going to put their own self-interest first and disappear with your money? And I've been shocked by both of those scenarios, frankly. I mean, transparently, it's been very troubling for me to understand what I could have done differently and what I could have learned from it. It's a lot easier for me to get into a spreadsheet and say, okay, this is BS, or yeah, this is a little bit rosy, but I can accept that risk. I'm going to take it. And I can look back on that decision and say, okay, I knew, eyes wide open going in, that this was going to be potentially a challenge in this pro forma. With those types of situations, it's just sort of out of the blue. So I think it really brings it back to diversification and how important it is. And I like the idea of taking small bets on operators, especially if you don't know them well or haven't invested with them before, and kind of spreading out your nest egg, so to speak, within this space, because you just never know what's going to happen. And if you're so concentrated in one position, I know a few people that were in that ATM deal that just got annihilated, 20, 25% of their net worth. And that's a devastating situation. So I think, taking small bets is prudent given these scenarios.
And I think the challenge for me, for these 3 deals we're talking about, has been to find what could I have done to avoid this? What did I miss? And the learning, like, how do I go forward with this? And so if I could just take a few minutes here, the first one, the Texas one with the multifamily, the problem there, I think, was this operator was doing multifamily heavy value add, multifamily development. He was doing triple net lease deals, and he was doing office to multifamily conversions, right? And so he was just doing too many things. And I didn't really realize all of that at the time. Like, it's hard to be an expert in all those things, especially if you're basically a one-man shop who's maybe partnering with people here and there. So, if you're doing everything and you don't have people that are running the other things, I'm out. Then you go to the ATMs. It took me a long time to figure this out, but I think the problem there was there were 3 or 4 layers of people and companies to go through until you got to the operator. I didn't even know the 3rd layer was there. which is embarrassing to admit, but that's where the fraud happened. It's very hard to police against fraud or to avoid fraud like bad actors, like you said, Paul. But I probably won't do any more deals where you got to dig 3 or 4 layers deep before you get to the person who's actually operating the thing. And then the last one, the San Antonio one, Paul, that we're both in, I don't know what I could have done differently. I think the one thing I'm glad of is usually when I found an operator like that one, I would have gotten into more than one deal with that person. And I had many opportunities. And something was just telling me, no, just let this one ride. And so I'm thankful that I did that, because on the other Texas multifamily, I did jump into more than one deal, right, one after another, which was a mistake. So it's hard to find learnings on some of this. And part of it is that's why you really, really have to get to know these operators, because, something bad happens and then they're trying to save deals and maybe they're commingling funds and doing all this stuff. And then all of a sudden they're doing illegal stuff and cheating you out of your money. And that was maybe not their intent at the beginning, but the people that just stand up and say, hey, I made a mistake. This is what we always told our kids, right? Hey, there's a broken glass on the floor. Okay, stand up and say, yep, I did it, right? It was me. Just own up. And that's what I'm looking for, people that are going to step up and say, here's the mistakes I've made. Because it's hard to avoid bad actors. I don't know how you avoid that altogether.
Well, and I think you bring a point there. Like, hey, some of those deals you have lessons learned. Other times just like, hey, that was just bad luck, right? Or hey, just, law of averages. Some go to zero. And going back to diversification. And then, my other rule is no more than 10% of my investable net worth with any one sponsor, and usually less than that in any one deal. Like, hey, diversify. And like you mentioned, those ATM people, like have in my recommendation, a single digit type allocation of your net worth into like one deal or one sponsor, because it does happen, and it will happen. Hopefully it's it's a speed bump versus like you getting wiped out. A couple things on my end here. I've got a couple deals here in Denver, and Denver's been a struggling market for multifamily that are underperforming. Now, luckily, we are just able to hold and not pay distributions. I say we, the sponsors are holding and not paying distributions, but they put really good debt on there and can ride out 2, 3, 4, 5 years of market cycle before it gets better. And then I also, a lot of these deals are part of like larger funds where they were also in some Midwest. So I'm a big fund person versus like individual assets, because, hey, I view stocks. Some of the Denver deals I did are underperforming, but then some of these deals, other stocks in the Midwest are performing really well. So even though the overall investment's still doing very well, even though some of the assets are struggling. Now, the biggest thing I've had is, as I got excited last couple of years, I made a couple like business private equity investments into like startups, and one specifically was actually a home builder here in Colorado where I've invested in some of their projects. The projects are doing well and have performed, but builders are having a really tough time right now. And these are single family home merchant builders. They may go bust, they may not. I believe in the sponsor, the CEO on there. I think he's a great guy, but there's just been a lot of like punch, kick, stomped on, kind of like all that stuff in the market cycle. And I am absolutely done investing in businesses unless it's through the stock market. So that's kind of like my biggest lesson learned is like, I know real estate. Why the hell, Lopez, did you go invest in businesses? I don't know how to underwrite it. And those are usually like zeros or heroes. And I may have a zero from there as well. So I've updated my thesis into no more business investing unless it's like the stock market.
Well, I'd like to jump in on that, Chris, because I chase the shiny object, right? And so I try to say, okay, no more than 5% of my portfolio I'm going to do stupid stuff with. And stupid stuff is investing in all these angel companies. And I've had 2 different results. One is it goes to zero, and I don't invest huge amounts, but like, okay, bummer, that's done. The other is it goes through the roof, goes public, and the value of my investment goes from $3,000 to $300,000 in a day. The problem is I can't get my shares converted and on a brokerage platform to sell. And by the time I do, my $3,000 isn't $300 anymore, it's $2,000. And so, like you, I am done investing in those kind of startups where I don't know the principal. Now, my one exception to investing in startups is when I know the principal, when I know the person. And so there's some that are affiliated with PassivePockets that I've invested in, and that are real estate related, people that are starting their own business, and I'll invest in those if I know and can call up the principal and say, hey, you just turned my 25 grand into 2 million. How do I liquidate it without going to a brokerage and getting, having those problems? So that's kind of total aside from real estate, but that's kind of how I'm doing those going forward, changing my thesis.
Yeah, I've taken the money I would invest in those business deals, and like I'm gonna actually start buying Bitcoin and more crypto type stuff. Like I'll take more of a bet on that. So I'm a little late to the party, but feel bigger the macro trends. But I can buy that through my Fidelity account.
I also think it's interesting when Paul and I, mostly me, we're talking about, our real estate syndication failures, and, the FBI is involved and people are losing money. And Chris is like, oh, well, I had a couple operators who stopped distributions. Oh, Chris, that must be tough on you. Here I am losing my full equity and you're not getting distributions. Shows you who to ask when you want to look into a deal. Call Lopez.
I'm not going to give me 20 years and we'll see how that track record goes, right? All right, so we're a couple months over here, but I want to wrap up our update here with last thing. Let's end on a good note. What's going well, right? Talked about some things going sideways, but what is going well? Jim, I'll start with you. What is going well?
I have some debt funds. Again, I don't mean to plug anybody, but IWC debt funds, that they're crushing it. They're returning over 15% annually, so I am loving that. And then I have a bunch of deals that I got into in maybe 21, 22 that I was really concerned about that are now to the point where they're going to return capital, and maybe they're not going to be 2x, maybe they're going to be 1.3, 1.4. But at this point, it's really good news just to get capital back on some of these things. Right now, I am focusing on not hitting home runs, but just getting some singles and maybe a double here or there and just getting some capital back. I got too into this when I first found all this stuff. I was like, this is awesome. And so I lost liquidity. So right now I'm trying to gain liquidity back, but I'm having some deals that are supposed to go full cycle in the next 3 to 6 months, and I'm super excited about it. Some will be singles, and I'm hoping for a double or two.
What about you, Paul? Good news.
Good news. I mean, the single and double approach I love. Having some really good success with debt funds as Jim is, spread across a number of different funds, and then some single assets where I'm a private money lender. I've had a couple deals where I've done seller financing on one that's about to go to market, and the owner is going to try to sell it. So that note could get paid off sooner rather than later. So I'm excited about that. I had another deal that looked like I was going to have to foreclose on the property. The buyer who bought it from another guy that I know was having some struggles with paying, the debt and keeping up with the property. And then the property went vacant and he had a lot of renovation costs. And I tried to work with him for a while. Ended up actually accepting a short sale. So I took a little bit of a haircut on my principal balance, but he had paid me over the course of like 16 months, the interest payments. So I came out ahead from a risk reward standpoint. Looking back, I probably wouldn't do it again, but I was made whole. So I was excited about that. And then from a passive investing standpoint, I've got some decent equity deals that are paying distributions. I had one deal that I was worried about would have a capital call, but I'm finding out that they're doing a cash neutral refinance. So it looks like the whole period's going to be a little bit longer, but the fact that, there's a bank out there that's willing to finance it without having to get additional capital from investors means that the asset seems to be on stable ground. So I feel like my principal is protected, which is a good thing. I haven't had a capital call yet. I didn't invest in a lot of deals with bridge debt, but there's a few. That was one of them. So I'm kind of grateful that that's working out the way it is with that asset.
I am like scared to death of doing direct lending, like, Lopez direct lending. I don't want to deal with it. Too much concentration risk. I'm always worried about when it forecloses. I don't want to deal with it. So like I want to debate you on that one day.
Only in certain markets will I do it where I have a solid property manager who I've worked with in the past that I can have them take over the asset if need be. And I know brokers that can sell the asset or have investors that are interested in stuff. But if it's just going into Omaha, for example, where I know nobody, I would never do that.
I'm on Paul's side on that. I love private lending, but only with 2 or 3 people that I know, like, and trust implicitly.
On my end, I feel like once the initial tariff chaos kind of settled down here, it just seemed like the sentiment changed the market. I mean, in quite a few deals I'm in, there's been a lot of interest. Actually, 2 apartments in Des Moines, Iowa, they went to market. These were, value add plays. They went to market. One had 9 LOIs on it, which, over a week, which was insane. Under contract at a really good price. Now that should sell here next couple months. Other one had 4 or 5 LOIs. So it's great to see that amount of demand for it. And actually one of them actually put down hard earnest money. And, hard earnest money has not been in favor the last couple of years because you haven't really had to. But there was so much competition. The buyer had to go out there and put down hard earnest money. Another deal that's actually this has been a surprise. So I mentioned I invested in that Ohio build to rent deal. It closed in, I think, May, or it actually closed in April. And it was a 4-year business plan, build, stabilize, sell. Well, 6 weeks after they closed, they got an offer from a private equity group to buy it when they got certificate of occupancy. So it'd be the same IRR, but it might be a 2-year plan versus 4-year plan. Now, that has not been like inked yet, but just the fact that an offer came in like that, I thought was amazing to see.
Yeah, that's nice.
That's good stuff.
So I'm curious, as we wrap up here, have you guys felt the market sentiment change either in like what you're seeing or any deals you're in? Because I feel like I have in the last 90 days.
I don't know. I mean, yes, I feel like we're on more solid ground. I'm a little bit more cautiously optimistic and putting my toes in the water and trying to get access to deals that are interesting in a number of different facets. I'm curious at next week's National Multifamily panel what these guys have to say. I'm very data driven. These guys have the data. They're very acute to what's happening in the market and are very smart guys as far as not just the data itself, but interpreting where it goes. And I don't know if I mentioned it before, it's August 22nd at noon Eastern. We should throw that in the show notes. So I think, the market is going to sort of plateau for a while and then will eventually take off. It's sort of a yellow light, not necessarily a full on green light, but I feel like if you wait for the green light, I've said this before, you miss out on a lot of the good opportunities. So I don't think, I can predict where the trough is necessarily. But overall, in the next couple of years, I feel like we'll be in a better place than we are today.
I would add to that, I think, over the next three to 6 months, we're going to be seeing a lot more deals that are ones that I would actually dig in rather than just delete, right? For the last year, I've just been delete on most of them. And now I think we're seeing some that we might start digging into.
Yep. It's okay to hold cash for a little bit because you're going to be happy you have it when those deals come along. There's an opportunity cost to allocating today, potentially. So
that's it for our first Passive Pockets Pulse Check. We'll be back every month with updates on our portfolios, the trends we're watching, and our best guesses at what's coming next.
Make sure to check out the forums at PassivePockets.com to join the conversation we mentioned today. Share your own deal experiences, challenge our predictions, and connect with other serious passive investors.
And if you're not already a Passive Pockets member, you can join our investor community with a 7-day free trial. Just go to PassivePockets.com. All right, we'll see you guys next month. Happy investing.